Mr. Amit Sachdev, COO M1xchange. So our panel is full, and Mr. Purti, the session, please take charge.
So moving to Amit, if you can share your business model and offering.
Sure, Wilson. So if Vivek is 1 year old, he's a kid on the block, we thought we are the kids on the block vis-a-vis the Kotak banks and Yes Bank and SBIs. But yes, in fintech ecosystem, we are a veteran, we are 6 years old. That's a long time in fintech world. This is before the GST started, before Demon started. So if I were to put in a nutshell what we do, we are an exchange for MSMEs, all MSMEs to get their receivables faster. So let me dwell on the key parts. One is exchange. Just like there is an exchange called National Stock Exchange, there is a BSE where you can trade in stocks. We enable MSMEs to trade on their receivables. So if you have receivable from a company, a large company or a government, you can come to the exchange and you can get your money today rather than waiting for 45 days time or 90 days time as a case may be. And you have a choice of 50 plus banks and now NBFCs as well. Well, RBI has been kind enough to finally allow NBFCs. So we are an exchange. And the second part is we allow you to trade on your invoices, get the money now. We have been live for last 6 years. We are one of the 3 RBI licensed exchanges to enable this business. We have about 16,000 MSMEs who work with almost 1,100 large companies and PSUs and governments to ensure that we can provide them almost 3,000 crore of funding every month, which is almost 36,000 crore of funding every year. So far in our journey, we have enabled almost 45,000 crore of discounting last 6 years since we have been live. That's what we do. Wilson said, a very nice question. Are we fintechs? Are we technology companies? Are we finance companies? I guess one problem that most bankers would have faced is the lack of that flexibility for the business and technology to come together and solve a problem, a real problem. I started my career in 02 and every year I was sharing with Wilson some time back. Every year since then, I would go to some SME forums and workshops, and this problem of credit gap of MSME would always come up. Each stakeholder, the regulator, the government, and the banks would think of this as a big opportunity, a problem, but how to solve has always been a problem. It used to be $100 billion gap way back in 02. Every 3 years, it kept increasing from 100 to 200. And in 15, when I started my journey to solve the problem, it was a $500 billion problem. Now it's grown to a $800 billion problem. So every year, the problem is increasing. But what the right answer was always a question. I think finally, the right combination of fintechs working with banks is coming to be the right solution. And the way I look at the whole problem solution has 4 elements. One is getting the customers in. Customer acquisition is a big problem for most models. It's not just financing, but you look at any industry, be it auto industry, be it you as an MSMEs, the customer acquisition is a problem. So who does that is a big problem to be solved. But MSME financing is not the problem of customer acquisition. It is a bigger problem of underwriting. It is a problem of you figuring out who is the good customer to be lent and who is not. So it is the risk management problem, and hence a very high focus has to go into figuring out how do you figure out, is it on a cash flow based lending, which is what I think we heard in the previous panel very appropriately. Is it on the balance sheet? But that's a key question, and that's something which most fintechs are working towards, including us. Okay. Essentially, what we are doing is we are funding a transaction. What we do is, as the previous panel said, the end purpose being defined is very important. and that's a core to our entire business model. We fund a transaction between a buyer and seller, and unless that is not known, we don't fund it. Now, what you're funding is multiple use cases. There could be a use case of a dealer selling to a large corporate. Let's say there is a slide, L&T is doing a project at a site, and there the diesel has to be bought. The dealer will supply the cement or diesel. Another use case which would typically be could be in a way funding the dealer. Just that rather than funding the dealer when he's purchasing the cement or purchasing the diesel, you're funding the leg when he's selling that to a large corporate like L&T. There could be another use case, which is where you have a auto component supplier selling to an OEM, right? Or an equipment supplier selling to Tata Steel. So there are multiple use cases, and hence to be able to exactly figure out how much is dealer financing and how much a vendor. It's a slightly tricky part. But if your question, Wilson, is how much of this is on the sales side and how much is of that is on the procurement side, yes, today I think about 9% to 10% would be on the sales side, and remaining is more on the vendor side. The whole focus and comfort of the banking community on MSME lending and uncollateralized lending is getting much better now. Multiple reasons for that, but the way I look at it, this is maybe post-COVID is like the fintech wave 2 or MSME lending wave 2. A lot of experimentation on uncollateralized lending, cash flow based lending, transaction based lending to MSMEs had been on. They were small experiments. I think the fintechs and the banks were collaborating to figure out what model will work or not, but they're small pilots. I'm sure the Yes Bank has been doing multiple pilots on GST based lending. Kotak Bank has been doing those pilots, but they were small. I guess what has happened over the last few years between wave 1 and wave 2, and wave 1 was between maybe 2014 to 2020, is a lot more data is now available, which was earlier not the case. GST started in 17 and people are still trying to figure out, is that data real, recent, are all guys reporting or not reporting? The access to GST was a problem. Now what's happening is GST is a lot more formal channel, 1.5 crore GST registered entities. That's a lot of entities. Easy to access data because you could, with the OTP, you could get GST data for last 2 years. Bank statements are now a lot more easily available. Account aggregators have come in. Earlier asking an MSME to download 24 bank statements for last 24 months because some banks were giving bank statements for a month, which means if I had to ask an MSME to give me access to his last 2 years of banking data would mean the poor MSME who has to run multiple things in his business to download 24 bank statements and upload it on the platform. A lot of task. Now with account aggregator coming in, almost 18 banks on account aggregator, it is one OTP. So the process has become a lot more, less friction than it used to be earlier. Can get better, definitely, but gotten better. So a lot of data is becoming available, which was not the case earlier. Bureau. The commercial bureau used to be very, very shallow till 3-4 years back, has gotten a lot more richer. Otherwise, to get access to the real repayment track record of an MSME, one had to go to the individual bureaus. And if there were 5 directors, which means looking at the 5 directors bureaus. And someone spoke about in the previous panel that an independent director coming in, now because this MSME who has not paid on time would reflect on the individual director's bureau as well, which would impact his ability to borrow it. So now with commercial bureau coming in, that data is a lot more richer. So just a core element of data being more richer, easily available is one part which has changed a lot. The second thing is most banks in a way have realized that the large ticket corporate lending has its own pitfalls. Very high concentration. One company goes down and suddenly you have a lumpy NPA sitting. And to compensate, now you have to have a lot of base denominator of clean book coming in, so that percentage looks better, right? Suddenly when the NPS shot up from less than 1 percentage point to more than 3%, 4% 5 years back, it shook the whole banking community, and they realized the importance of a granular book. So the focus on retail, focus on MSME, retail has become a lot more competitive. Every bank has been able to find models to give loans to salaried people, but SME is the is the middle piece, which is neither in the corporate side nor the retail side, and that's a very attractive opportunity. So a lot of banks are getting attracted towards MSME. It's the other part. So I've not seen that openness on unsecured MSME lending for last 7 years. I've been trying to solve the problem of MSME. So that's a very, very welcome change. I think third part, and not to discount that, is the whole focus of the government. India as a country, the amount of focus we are showing on MSME, and all of us knew that MSME sector contributes some 40% to exports, to employment, 30% GDP. It's been talked about in each workshop I've been to last 18 years or 20 years time now. But this government has finally shown the focus of bringing changes which are required for the MSMEs to get uncollateralized debt. The CGT MSMEs has been there, but it has its own pitfalls. Now CGFSF is coming in, which will allow banks, NBFCs and platforms to benefit from the fund for factoring. The factoring as a product being made a lot more beautiful than it was earlier. So multiple things happening from the regulatory government ecosystem to ensure that this can happen. And this is showing up in the whole partnership between banks and fintechs, which is important. So that's one part why there is so much of fondness, so much of liking for unsecured MSME credit. And as I said, the key to solving the problem, it's a big animal. 1.7 trillion is what the co-panelist said. Indian number I knew of was $800 billion. The key is digital underwriting, digital risk assessment, and for which multiple experiments have to happen. I don't think anyone has the answer right now. We've been trying multiple experiments. It will take maybe another 5-10 years for us to get enough data to get to a scientific AI data-based or data science-based modeling to predict who's a good borrower, who's not a good borrower. Right now, there are enough pilots, experimentation which are underway. But hopefully we are on the right track. And for this pilots to happen, there has to be a mix of technology element to come in. There has to be the right blend between the experts of underwriting, risk management to come in, to sit together, brainstorm, and figure out how to tweak the models each day, each passing day. And now that experimentation is where I believe fintechs come in, because they are more nimble, more flexible, they have in-house technology teams, and hence this tweaking and learning can happen faster. There'll be failures, there'll be success. Both ways there'll be more learning to figure out what to do and what to scale up. And that's where fintechs come in. The banks come in with very, very low cost of funds. They come in with their compliance regulatory structures, which ensure that whatever is done in a very, very system which is predicated on high corporate governance. The two coming together is the answer. And I think this is how it is going to take shape for next 5 years. It's funny because the devil is in the detail. When we say that there's a lot of data which is available on banking, on GST, on the credit bureaus, it's all about how you deal with this data and what you do with this data. There are a lot of granular problems which have to be thought about. The answers have to be thought about, and that's where the innovation lies. So for example, if you have a bank statement of an MSME and you have 1,000 lines, now what you do with these 1,000 lines is the big problem. And I think previous panel talked about getting the answers, how a physical underwriter will look at that bank statement, but getting it digitally. That's the key. Now you have to figure out as an underwriter, on how healthy is the business, which means the first thing you have to figure out is the revenue of this business growing or not growing? Now in financials, you could get just a one figure for the whole year. The bank statement can give you that number for each day, for each week, for each month, which means you will have maybe 52 data points to look at his weekly revenue, and you will see whether his revenue is going up or going down. Some of the 1,000 data points or lines may be about his vendor payments. So you figure out whether his entire trend of vendor payments is increasing or stagnating or decreasing, and is it that line with the whole revenue trend or not. To figure out if you've actually been able to get all his bank statements and all the information. If he has taken any loan recently, which has not appeared in his CIBIL, because CIBIL starts reporting with a lag, but it is existing in his bank statement. So can you triangulate the two sources so that you have complete understanding of his entire obligations or loans? So that's where these are the small problem that have been solved with the use of technology, automation, so that you have a much better understanding of his MSME's business than it is possible manually, because nobody can look at 1,000 data points in a few minutes time as a person. It is impossible. This is where tech comes in. This is where automation comes in. Every organization, every fintech has to find answers on its own on how to get answers to these problems. This is where the real value lies. The rich insights coming from that data. Now, whether you look at and the way you look at an Indian business versus you look who's selling in domestic market versus looking at somebody who's selling in export market and getting money in euros and Japanese yens and dollars, and how much of that is coming here versus, for example, figuring out if I'm getting money in foreign currency, but which geography is the buyer in? For example, if the buyer is sitting in Pakistan, he's only one buyer, or China, then you are selling or your business has a high concentration in a geography which is politically very sensitive. So maybe not a great business. Now, how do you build these insights into your algo, into model will define the success or not a very successful model. So to answer this question, let me look at some of the successful models which are working on between fintechs and banks. And there was a time when the fintech revolution started in India, and some fintechs used to be very aspirational to say that, listen, we'll kill the banks. And I think those were early days. People were still trying to figure out what will work, what will not. And I think it is very kiddish to believe that the fintechs can actually kill a large institution like a bank, which have been here for decades now. I think that would never be the right answer. The answer is let's figure out what is a problem statement that a fintech can solve for, and whether it can solve that in partnership or in competition with the banks. That's the way to look at it. If I look at the different capabilities required to solve the MSME problem, there are 4 aspects to ensure that the liquidity is available and available at the lowest cost. Number 1, first there has to be liquidity. There has to be somebody with the money. Fintechs usually will not have the money. There will be startups, right? So you have no choice but to work with an institution like a bank who has the capital, number 1. Number 2, there are 4 essential costs in the whole lending problem. One is cost of acquiring the customers. And who has the best capability to acquire a customer? A bank with X thousand branches. Will the fintech with its pure digital reach, spending on Facebooks, spending on LinkedIn, spending on Google's, be able to compete with that cost? Unlikely. So they are well placed to look at the whole cost of customer acquisition. Number 2 is the cost of funding. The cost of funding, a startup will never be able to match the cost of funding with CASA of 40%, 50% sitting with a bank. Number 2. Number 3 is the whole cost of underwriting or the cost of operations, managing the whole backend. Once the application comes in, then how do I manage the whole backend? Which is where there's a huge element of technology, automation, digitization, or what in banking system is called no ops. That's a dream state of no ops, which cannot be achieved unless there's a huge amount of tech driving that. which is where I believe today banks are not able to get to that level of perfection because they don't have the in-house technology element. The dependence on the vendors has a limitation because the speed is lower, which means you cannot before you can get to the next version, you have to wait for 2 years for the RFPs to come in, for the whole BRDs to be completed, development is to be completed, adoption, it takes 2 years time. The fintechs can crunch the time frame from 2 years to a month, and that's where they can learn much faster. So this is where I believe the cost of underwriting, cost of operations can be much lesser if fintechs play that role, banks play the role of customer acquisition, and the cost of capital and the cost of compliances. If you put the two together, is where you have the lowest cost of lending for SMEs, and this is what we're finding in our model. So as TReDS, today we discussed about the whole factoring being less than 0.5% of GDP. The number is $9 billion. And out of $9 billion, almost 30% of that book is coming from TReDS. Factoring as a product was a dead product in India till 6 years back. Till the point TReDS came in and they said, listen, it's a beautiful product. The problem is it has been implemented, it has been executed with a very, very physical layer where you cannot have an audit trail of whether the buyer has accepted that assignment done by the seller or not. So let's bring in technology, let's bring in a complete transparency and audit trail of the whole transaction being assigned, which is the underlying model of factoring, and being accepted by the buyer. So buyer tomorrow cannot say, I never accepted the transaction. Now that is growing at almost 100% year on year. And this is happening in partnership with more than 50 banks. Almost 20,000 crore of outstanding in partnership with 50 banks, which is now working well. That's the largest fintech model operating in the country very successfully. The role of TReDS today lies more in managing the whole transaction. By the way, while my hypothesis was that the customer acquisition would be best done by the banks, but today the TReDS are doing the whole customer acquisition as well. The large corporate customers, SME customers, and it is enabling a bank down south to look at a customer up north, which would never have been the case for a bank like a KVB or a City Union Bank to fund a Jindal who is a north-based corporate or a MSME based in Gurgaon. Would not happen. Vice versa, taking a bank which is there in north, a PNB, and letting them get to a customer down south is not today possible because of this partnership. So to me, this is the core to success. Hopefully these models will scale up and multiply going forward.
Yeah, so my question is pertaining to where we were discussing about risk and all. And one of the points you touched upon is the buyer and seller dependency. So in your entire risk analysis, if I have to say, suppose, what will be the weightage you give to a data that how much a buyer and a seller is dependent? Because I want to know that the independent GST and all those analysis which you do, what level or degree of credibility that gives about the customer vis-a-vis a buyer and seller data which has existed in a platform or a portal which you can leverage. So that is my question to the team.
As always in life, there are no black and white answers. There are always shades of gray. And again, depends on that specific case. But let's say if you're looking at one seller selling only to Tata Steel. Tata Steel is a fantastic company with decades and centuries of vintage, and that's absolutely fantastic. I think the model will love it. But if, let's say, there is, as I said, only one customer that this seller is selling to, and that seller buyer happens to be sitting in Pakistan or China, which is geopolitically very sensitive. It's bad news, right? So higher concentration is usually not good, not preferred, because something which goes wrong with one customer can completely rock the model. So most models will prefer lower concentration, both on supply side and buyer side. However, as I said, there are cases where if you have a really solid buyer, for example, Tata's, I think the models will still love it.
No, my point is, suppose you have a 10 crore of budget and I have asked that I want to fully utilize it. You will run a model. So what percentage of it will you be able to cover through independent, say, digital document upload, vis-a-vis if any firm, be it Tata or any platform who has aggregated the data for so long, this buyer is dependent on this seller for these many years in this frequency, will help you aid to that. So what degree of risk will you take vis-a-vis what degree of risk you will take once this data is provided? Just a not a gray or a kind of what is the norm which you do? That is what I want to understand.
So maybe I can give the platform answer. And there are financiers who operate and the platform as a financiers. They have their own set of constraints. So most financiers who operate on the platform for our unsecured, uncollateralized risk on an MSME, usually with the whole underwriting being done on GST and banking, they would go up to 1 to 2 crore of limit sanctioning. And with the data coming in from an anchor as well, with enough vintage, etc., that could go to maybe 5-10 crores as well. So
that is the third model which we can talk about, that not only NBFC and fintech,
right,
maybe the anchors, data analytics and tech team will be also critical in this entire project. So just that was the point I wanted.
Very valuable. Yes.
One last question first.
So this is for Mr. Sachdeva, that you have told about that KVB Bank of South taking over the clients in North, as well as the Bank of Punjab National Bank taking over the clients of the South by way of trades. So can you please elaborate how it's trades? Little that, because we are in a physical distribution, probably this could be of help to us.
Yeah, sure. So the whole TReDS stands for Trade Receivable Electronic Discounting System. The model is as mandated by the Reserve Bank, which regulates us. We have been mandated to enable the MSME suppliers of any company, could be a PSU, could be a private company, to get their invoices discounted on the platform, which is subject to the buyer. Buyer, as said, could be a private corporate, could be a government institution, could be a government body, confirming that this is a genuine invoice on the platform digitally. No email, no physical work involved, just that they do a tick mark that this is a genuine transaction. Subject to that happening, there are some 52 odd financiers now on the platform. They compete for each invoice. All the interested banks would just have to come and bid, just like you would come and bid for buying a stock on NSE. You come and bid for buying that invoice and discounting that invoice. So there could be, for example, 20 banks, and they would show interest. It's up to the MSME or the buying corporate to accept any specific bid. More often than not, you will accept the lowest bid. So now KVB, without having to worry about where exactly is the seller or buyer, could be sitting in Kochi, for example, in their head office, could bid on this.
Okay. One addition to the last point, I'm very much aware about your platform, and M1xchange is mainly doing for discounting for a company turnover below 500 crores. And whenever we approach your organization, it has been told that if it is a more than 500 crore organization, it will be treated as an M2 exchange. So the rate of discounting in M1 and M2 is different. And now the companies who are dealing into such high value added commodities, this kind of turnover crosses very fast. So right, how can it be that the same rate of discounting is applicable to both kind of company on your platform?
Sure. So on M1xchange, the only constraint from RBI is the seller has to be an MSME, which means you have to have the Udyam Aadhaar. Now, as per that definition, the turnover ideally should be less than 250 CR for you to be able to get the whole benefit of liquidity on M1xchange, the TReDS platform. Now, that is not, again, RBI has clarified that even if you changed from being an MSME to a non-MSME, which means you grew beyond 250 CR of turnover in last 3 years, you can still participate on M1. That's fine. But let's say if you became a non-MSME 3 years back, then yes, you can't do it on M1 as a seller. As a buyer, of course you can, but not as a seller. And the moment you are not an MSME, the banks don't get what is called a PSL, priority sector lending, which is where the moment you're a non-MSME, the rates tend to become slightly higher. So that's a difference why you'll find the rates to be slightly different, but otherwise M1, M2, you can get the same benefit across the board.
Thank you.
And Mr. Amit Sachdeva. I think the person to whom the maximum questions are going to be directed have already been